Have you ever wondered how the stock market can be so unpredictable, yet some investors seem to always know where it's headed? What if you could decode the trends that drive the US financial markets and use them to make more informed, profitable decisions? If you're ready to unlock these secrets and take control of your financial future, hit that subscribe button and help us reach 1,000 subscribers. We have a lot more valuable content coming your way. So, let's dive in. Main speech, market trends and analysis. Good morning, afternoon, evening, everyone. I'm so glad you're here today to talk about something that impacts each and every one of us, whether you're an experienced investor or just starting your financial journey. Market trends and analysis. In the ever-changing world of finance, market trends act as a compass that helps us navigate the stormy seas of investments, stock market movements, real estate, and much more. For anyone involved in the financial markets, understanding these trends is crucial for making informed decisions, protecting your wealth, and even growing it. But what exactly are market trends, and how can we identify them? To start, market trends can be broken down into three basic categories: bull markets, bear markets, and sideways markets. Each of these trends offers unique opportunities and risks. A bull market is when prices are rising, optimism is high, and investor confidence drives upward momentum in the market. A bear market, on the other hand, happens when prices are falling and pessimism reigns, leading to a decline in investor sentiment. Finally, a sideways market is where prices remain relatively stable with little upward or downward movement. Let's focus on the current market trends in the US. After years of volatility due to the pandemic, inflation, and changes in monetary policy, 2025 is shaping up to be a fascinating year for investors. In this talk, we'll explore the key trends that are shaping the market and how you can position yourself to take advantage of them. Trend number 1, inflation and interest rates. One of the dominant trends that investors are facing today is inflation. The US economy has experienced a surge in inflation over the past couple of years. As inflation rises, the Federal Reserve typically increases interest rates to cool down the economy. But here's the catch. Rising interest rates have a direct impact on investments, especially stocks, bonds, and real estate. If interest rates rise too much, the cost of borrowing increases, which can lead to lower consumer spending and investment. This usually puts downward pressure on stock prices. However, growth sectors, such as technology and healthcare, often perform well even in high-interest environments, as long as they are generating strong revenues and have solid fundamentals. For investors, understanding the Federal Reserve's moves and inflation predictions can be key to making timely decisions. Monitoring reports from the Fed and watching inflation data closely can give you a heads-up on where the economy is headed. Don't forget, rising inflation also erodes the value of cash. So, having cash sitting idle might not be the best option right now. Trend number 2, technology and innovation. The technology sector has been one of the biggest winners of the last decade, and that trend is not going anywhere anytime soon. The rise of artificial intelligence, cloud computing, cryptocurrency, and electric vehicles has reshaped industries across the board. Take, for instance, the artificial intelligence boom we've seen in recent years. Companies like NVIDIA, Alphabet, and Microsoft are leading the way with AI advancements that promise to revolutionize everything from healthcare to financial services. Investors who have positioned themselves in these companies have seen impressive returns. But this doesn't mean every tech stock will perform well. Innovation is a key driver, but so is the company's ability to adapt. So, if you're looking at technology stocks, remember to do your research. Don't just follow the crowd. Look at the fundamentals of these companies. Are they generating consistent revenues? Do they have strong competitive advantages? And most importantly, are they investing in the future? Trend number 3, real estate market dynamics. Now, let's talk about another big trend, the real estate market. As we all know, real estate is a major part of the US economy, but the market is facing its own challenges and opportunities in 2025. After a period of skyrocketing home prices and low mortgage rates, the housing market has started to cool down. Higher interest rates have caused mortgage rates to rise, which makes home buying less affordable for many people. As a result, Some regions in the US are seeing a slowdown in home sales, while others, particularly in suburban areas, are still experiencing growth. For real estate investors, this presents a bit of a balancing act. On one hand, higher interest rates can lead to fewer buyers in the market, which could drive home prices down. On the other hand, rental demand is still strong, especially in areas with growing populations and jobs. Investing in rental properties could be a good move for those looking for steady income, as long as you choose the right locations. So, which one should you choose? The answer is that both might be the best option. Here's why. If your employer offers a match, contribute enough to take full advantage of that match. Once you've done that, open an IRA, whether it's traditional or Roth, to get more control over your investments and potentially take advantage of tax-free growth. Use a Roth IRA if you expect to be in a higher tax bracket when you retire, or a traditional IRA if you want an immediate tax break. Ultimately, the more you save, the better off you'll be in retirement. Retirement planning can seem overwhelming, but by understanding the differences between 401ks and IRAs, you can make informed decisions that will set you up for success in retirement. Don't wait, start saving today. Before we end, don't forget to subscribe if you haven't already. I'm aiming for 1,000 subscribers, and I'd love for you to be part of this journey. Leave a comment below. Are you currently contributing to a 401k, an IRA, or both? And what's been your experience? I'd love to hear from you. Thank you for watching, and I'll see you in the next video. With a 401k, your employer typically provides a selection of investment options, which may include mutual funds, ETFs, and other options. However, the downside is that you may not have complete control over your investment choices. Some people may prefer more flexibility, and if that's you, then an IRA might be a better fit, which we'll cover next. Case study. Let's say you're contributing $2,500 to your 401k each year. If you're invested in a well-diversified portfolio of low-cost mutual funds, your investments could grow substantially over time. For example, if your average annual return is 7%, you could have over $1.1 million in your 401k by the time you're 65. But again, your options are limited to the funds your employer offers. What is an IRA? Now, let's move on to IRAs, which stand for Individual Retirement Accounts. The key difference here is that an IRA is something you set up on your own. You don't need to go through your employer to open an IRA, which gives you much more flexibility when it comes to investment options. There are two main types of IRAs, the traditional IRA and the Roth IRA. Let's start with the traditional IRA. When you contribute to a traditional IRA, your contributions are tax deductible. This means you can reduce your taxable income for the year by the amount you contribute. For example, if you contribute $6,000 to a traditional IRA, your taxable income for that year will decrease by $6,000, potentially lowering your overall tax bill. Example, let's say you earn $60,000 a year and contribute $6,000 to a traditional IRA. Your taxable income for the year would drop to $54,000, meaning you could pay less in taxes this year. However, the catch is that when you retire and start withdrawing from the account, you'll pay taxes on the amount you take out. Roth IRA, the tax-free option. Now, the Roth IRA is a bit different. With a Roth IRA, you contribute after-tax dollars, meaning you don't get a tax break when you contribute. However, here's the big advantage. All of your earnings grow tax-free, and when you retire, your withdrawals are also completely tax-free. This is a huge benefit for people who expect to be in a higher tax bracket when they retire. Example, let's say you contribute $6,000 each year to a Roth IRA, and over the course of 30 years, your investments grow at an average annual rate of 7%. By the time you retire, you could have over $500,000, and when you withdraw that money, you won't owe a penny in taxes. This makes the Roth IRA a great choice for young professionals who expect their income to grow over time. Contribution limits and flexibility of IRAs. Now, let's talk about the contribution limits for IRAs. In 2025, you can contribute up to $6,500 per year if you're under 50, or $7,500 if you're 50 or older. While this is significantly lower than the 401k limit, IRAs give you more flexibility in terms of how you can invest your money. Imagine waking up at 65 and realizing that the money you've saved for retirement isn't going to be enough. What would that feel like? The sad reality is this happens to many people, but it doesn't have to happen to you. Today, we're breaking down two of the most powerful tools for building your retirement: the 401k and the IRA. Understanding which one or both to use could be the difference between a comfortable retirement and financial stress. Hi everyone, welcome back to the channel. If you're new here, I'm excited to have you. Today's video is going to be one of the most important ones yet. We're diving into the world of retirement planning, which is absolutely critical if you want to retire comfortably in the future. We'll be comparing two of the most popular retirement accounts, the 401k and the IRA, and we're going to break down everything you need to know. But before we dive in, if you haven't subscribed yet, please hit that subscribe button. I'm aiming for 1,000 subscribers, and your support would mean a lot. So go ahead and subscribe, and let's get started. What is a 401k? All right, let's start by talking about the 401k. A 401k is a retirement savings account that's offered by your employer. In a 401k, you contribute a portion of your paycheck to the account, and the money is deducted before taxes. This means you reduce your taxable income for the year. If you make $60,000 and contribute $6,000 to your 401k, you'll only be taxed on $54,000 for the year. Now, many employers offer a match on your contributions. This is free money from your employer that goes directly into your 401k on top of your contributions. For example, your employer might offer a match of 50% of your contributions up to 6% of your salary. This is essentially a raise that you didn't have to do anything for, just for contributing to your 401k. Let me share an example. Let's say you earn $50,000 and contribute $3,000. If your employer matches 50% of your contributions, they'll add another $1,500, bringing your total contribution to $4,500. That's money you didn't have to work for. Interactive moment. Think about your job for a second. Does your employer offer a match? If you're not sure, go check it out. And if they do, are you contributing enough to get that match? Drop a comment below and let me know how much you're contributing. Contribution limits and investment options in a 401k. Now, let's talk about contribution limits in a 401k. In 2025, you can contribute up to $22,500 to your 401k if you're under 50. If you're over 50, you can contribute up to $30,000 thanks to catch-up contributions. That's a big advantage over other retirement accounts like the IRA, which we'll discuss shortly. In 2025, cybersecurity, cloud services, and automated technologies are expected to continue their upward trajectory. The US government and major private corporations are investing heavily in these areas, and companies that lead in innovation are set to profit in the long term. However, tech stocks are often volatile. The rapid pace of innovation can lead to sudden market shifts, where companies can either rise to dominance or fade into obscurity if they don't adapt quickly. Key takeaway: the technology sector, especially AI and cloud computing, remains a promising area for investment, but it requires careful research. High returns are possible, but so is high volatility. Trend number 8: the real estate market in 2025. Real estate has always been a cornerstone of the US economy, and the housing market is something that everyone pays attention to. After several years of soaring home prices, rising mortgage rates have begun to slow things down in some areas. However, the real estate market is still thriving in many parts of the country, especially in suburban and rural areas. The pandemic accelerated the shift away from urban living, with more people moving to the suburbs or even rural areas. With remote work becoming more common, people are looking for more space, both inside and outside their homes. This trend continues to impact where homes are bought and sold. However, the rise in interest rates has made borrowing more expensive, cooling down demand in some hot markets like California and New York City. But there are still many areas where prices remain strong, especially in places like Texas, Florida, and the Southeast. For real estate investors, this means a potential shift towards more rentals and multifamily properties. As home ownership becomes less affordable, more people are turning to rental properties, creating opportunities for those looking to invest in long-term assets. Key takeaway: the housing market is cooling in some areas due to rising mortgage rates, but strong demand persists in others. Real estate investors should be strategic, focusing on rental properties in high-demand regions. Trend number 9: the growth of sustainable and ESG investments. Sustainability is not just a trend, it's a fundamental shift in how people think about investing. Over the last few years, we've seen a significant rise in ESG, environmental, social, and governance investing. More investors are looking to put their money into companies that prioritize sustainability, ethics, and social responsibility. This movement is especially strong among younger investors who are prioritizing the environment and social justice. Companies that meet these criteria are expected to outperform in the long run, as they attract consumers who value sustainable products, as well as investors who are increasingly looking at impact investing. But here's the kicker: ESG investments don't just do good for the world, they can also generate good returns. From renewable energy to electric vehicles and green bonds, sustainable investing is growing rapidly. Major funds like BlackRock and Vanguard are now integrating ESG criteria into their investment strategies, reflecting a shift in the industry. Key takeaway: the ESG trend is more than just a fad. It's a growing force that could offer both social benefits and financial rewards for investors. Trend number 10: cryptocurrencies and digital assets. Cryptocurrency has become an undeniable force in global markets. Over the last decade, we've seen Bitcoin, Ethereum, and other digital assets skyrocket in value, attracting millions of investors worldwide. But the volatility that comes with digital assets can be nerve-wracking. In 2025, cryptocurrencies continue to attract attention, but regulation is becoming a major concern. The US government is working to create clearer guidelines for digital assets, and this could have a major impact on the future of crypto investments. If you're looking to invest in cryptocurrencies, you need to be aware of the risks. While crypto offers incredible growth potential, it also faces regulatory challenges and price swings that can make it an uncertain investment. Key takeaway: cryptocurrencies remain a high-risk, high-reward investment. Regulatory developments will play a major role in determining the future of digital assets in the US. Navigating the future of market trends. As we look ahead to 2025 and beyond, it's clear that the US market is entering a new phase of evolution. From inflation and interest rates to the rise of AI and sustainability, the trends shaping the market are complex and multifaceted. But by staying informed and understanding these key trends, you can position yourself for success, whether you're investing in stocks, real estate, or digital assets. Thanks for tuning in today. If you enjoyed this deep dive into market trends, don't forget to subscribe and help us reach 1,000 subscribers. Let's keep growing this community so we can continue to bring you the best financial insights. Stay smart, stay strategic, and keep investing in your future.